Okay, are we ready? In the era of new technologies, right? We are having still problems. Okay, so let's start. It is my pleasure to welcome you to the fourth session of today's conference. Our session will address the reforms for global financial resilience envisaged in the Eminent Persons Group, the report. Please allow me to open this session by saying just a few words on the context of this report and by introducing our distinguished speakers today. In April 2017, the G20 of finance ministers and central bank governors tasked the Eminent Persons Group with the job of recommending reforms to the global financial architecture and governance of the system of international financial institutions, so as to promote economic stability and sustainable growth in a new global era. The group had also to consider how the G20 could better provide continued leadership and support for these goals. The group completed its mandate with the publication in 2018 of the report, Making the Global Financial System Work for All, where a set of recommendations are put forward. These recommendations are structured around three broad sections. The first section covers the proposals aiming to enhance the collaboration across the system, taking advantage of the potential synergies between the different institutions. The second section proposes several reforms to increase the global financial resilience. Looking at the title of this panel today, it is clear that we will focus on this part of the report. Finally, the third set of recommendations aims to reshuffle the role of the G20 and the IFIs in the global financial architecture. Even though we will be focusing on one of the sections of the report, this is still quite a lot of ground to cover. But before getting down to the discussion, I wanted to note that we had a last-minute change in our panel composition today, because unfortunately, Mr. Andrés Velasco, who is one of the members of the Eminent Persons Group that produced the report, informed us earlier today that he would not be able to join us this afternoon. Nevertheless, we will still be able to discuss in depth the report conclusions and follow-ups with the rest of our panelists. In addition, we also have with us in the first row of the floor, Mr. Jacob Frenkel, who, as you all know, participated in one of the panels this morning and is also a member of the Eminent Persons Group. He may say a few words on the report at the end of the initial interventions. Regarding the panelists sitting next to me, I'm very happy to introduce Ms. Elena Flores. Ms. Flores is Director General for International Economic and Financial Relations, Global Governance and Global Governance at the Directorate General for Economic and Financial Affairs in the European Commission. Ms. Flores has held several European Union-related positions, from where she has been an exceptional witness of the reforms process over the last years. Ms. Flores has kindly agreed to start off the discussion by providing a general overview of the reforms proposed in the EPG report from a global and EU perspective. After that, we have the fortune to get a first-hand perspective of the upcoming G20 presidency's views on these issues and its planned follow-up work. This will be provided by Mr. Turki Al-Mutairi, Deputy Governor of Research and International Affairs at the Saudi Arabian Monetary Authority, who I am very glad of having here today with us. Mr. Al-Mutairi has a deep knowledge of the international financial institutions, as he has worked as an advisor to the Executive Director for Saudi Arabia at the International Monetary Fund, and as an alternate Executive Director for Saudi Arabia at the World Bank. Thank you for coming. The role of international organizations to help address the challenges identified in the report is particularly relevant in emerging economies. I am thus pleased to announce the participation of Mr. Ottavio Damaso in this session, who will touch on the role of international organizations in coordinating global efforts to deal with rapid changes and emerging challenges in financial markets reforms. Mr. Damaso is Deputy Governor for Regulation of the Central Bank of Brazil. He also has previously served as Deputy Secretary for Economic Policy at the Ministry of Finance. Thank you very much for coming today to Madrid. Following the presentation of Mr. Damaso, I am delighted to have the presence of Mr. Carlos San Basilio. Carlos is Secretary General of the Treasury. Prior to his current position, he was Head of Resolution at the Spanish Resolution Authority, and I certainly know him well. We both sit together in the Governing Council here in this house, in Banco de España, and we have worked together ever since I was appointed Deputy Governor. Carlos will share with us his views from a Spanish perspective on which reforms are more pressing, where we could progress more quickly, and where efforts should be concentrated, and what challenges remain ahead. Again, thank you very much to all the participants. And as you know, I'm going to be the timekeeper for this session. So I would like that we all try to stick to the 10 minutes that you have for our initial questions. And following your initial interventions, we will have maybe 30 minutes for additional questions. And I will try to raise some follow-up questions, and we will then open the floor for the discussion. So, Elena, I'm sure that you can provide us with a more general picture first of the reforms contained in the G20 report. And probably we will be delighted later to listen from you and to really pay attention to your presentation on the European perspective. Of course, as you are going to cover more than one topic, well, maybe I can give you more than 10 minutes. You have the floor.
Thank you very much. Maybe I can go there. Then to the Banco de España and the Reinventing Bretton Woods Commission for this super well-organized conference. I found it really very, very interesting up to now, and I will try to do my best to keep it at that very good level. So you asked me to give some general overview about the report, and please let me know if I go over the time, because I think it's important to have time for discussion and also to get the views of other people here in the room that have also very interesting experiences on those matters, and in particular Mr. Frankel, who is part of those group of people that have developed these ideas. So again, I mean, I'm from the European Commission, but I would like to really share here a bit freely my views, not necessarily sticking to Commission view, particularly now that we have a new Commission, so we still don't know exactly what will be the policy line in the future. But my experience being participating in the G20 meetings for now more or less 4 years on the finance track, the way I saw the genesis of this report is that somehow G20 was in a bit of a stalemate, and the various presidencies tried to find a way to reinvigorate it and maybe to get some outside views and proposals to renew a bit the focus of the discussion. That's one, and two, I think it was also triggered by a number of challenges, in particular, as you mentioned, in the sort of making MDBs working as a system, also in a context of an increased number of players globally, which not necessarily very well coordinated approach to things. Then the whole discussion about, let's say, what are the global risks and how do we assess these risks and how do we link the risk assessment with the policy making, I think was another of the weaknesses behind the triggering of this report. And also the question of, the global financial safety net, which again has been, the number of players have been increasing, and those players are more diverse than they used to be some years ago. And the linkages between these players also merit some reflection. So in my view, those were a bit the triggers for this report. And I have to say that my personal reading, first reading of the report, compared to what my expectations were, it was like, okay, it remained a bit on the general level, but at the same time I saw later on in the follow-up discussion that it was probably the right way to do it, but in particular to trigger the discussion and try to differentiate between where to focus the priorities and maybe other things that are considered less of a priority by, let's say, the policy makers on the policy responsible. Now, also in my personal view, the way the G20 received the report was a little bit muted, I would say, and unfortunately, to my view. And, but I also see that a number of G20 players, not all of them, but a number, are really strongly pushing for keeping this report alive, and that number includes the European Commission, because we really think that there are a number of proposals that are really, really to the point on what are the challenges now, and they would really merit to be developed. And maybe in the end there is a decision to say, well, no, we don't follow up, or we do, but at least there is a need to think further how we could translate that and whether we can translate those proposals into something really operational. So that's a bit for the background that you asked me to cover without going into all the details, but really I think this group gathered a lot of very diverse and very, very deep experienced people, and I think it's worth to put attention to some of the proposals that they put on the table, if not all. So we understand, from the Commission point of view, we understand that the G20 presidencies cannot work on everything, and they have to focus on priorities. That's why we supported very much the Japanese presidency in choosing some very clear priorities to work on the report. But we strongly believe that this work needs to continue through a number of presidencies, because most of these proposals obviously cannot be implemented in 1 year's time, not even in 3 or 4 years' time. But they need to be started. And some of them, we think they need to be started quite urgently. So I will concentrate my comments on a number of the proposals, limited number of the proposals. Those will be basically related to what we discussed this morning about capital flows management, the early warning, risk assessment and translation into policy, and the third block will be on the global financial safety net. So the key questions, as I already mentioned, behind the report seems to me are, what does the global financial governance system really work as a system? And I think this notion of system is a red line across the report. It applies to different aspects. But thinking about the global governance system as a system, not as a collection of institutions with different mandates, different governing boards, etc., that's fine. But respecting that, one has to think about this as a system. The second preoccupation, I think, it was how to get more private flows into emerging market and development countries, meaning that, okay, the needs for development cannot be covered by public money, that's clear, and there is a need to think about how to mobilize private capital into those needs, and this is the whole reflection about MDBs that I'm not going to enter into that today. And then how to improve the global financial safety net and the economic and financial surveillance. So coming to the first package of proposals that I would like to comment upon is the one related to the capital flows management and let's say how to improve the compatibility between opening of the capital accounts and protecting financial stability. I think that it is clear that in the current environment, we should expect capital flows globally to increase further. I don't see any reason why that should be the contrary. And so the way that countries can react to that, it's not less but more important than before. Following the 2008 financial crisis, what we have seen already this morning is that global imbalances in terms of capital flows have moved more to advanced economies compared to the previous situation. And second, the nature and the structure of these global financial flows has been modified, and now they are much more market-based, and they are linked, as we have seen this morning, to US monetary and trade policies, which are triggering a number of these flows. So that has, I think, already been discussed quite at length in the previous panels. One example of this from our experience is that in the euro area, since 2013, it has been a leading net exporter of capital due to a large net outflow from the euro area and from the EU as a whole in the portfolio investment category. And these capital flows from the euro area, they have been invested heavily abroad in debt securities, especially in the US, taking advantage of the interest rate differentials. So this is one example of changing the nature of the flows that I mentioned. And clearly, we think that, as it has been also said this morning, capital flows are beneficial for both sending and recipient countries as a matter of principle, but under certain circumstances, they can be problematic, in particular in cases of excessive volatility. So we are not talking about managing capital flows as such, but we are talking about managing situations where, in particular, excessive volatility poses a risk for financial stability. And this is also important to see whether these capital flows, where they are in terms of composition, because that will have different consequences, as you all know, whether it is more like FDI content or it's more like portfolio and market-based movements. As Mr. Frankel said this morning several times, it's important that let's say the benefit from free flow of capital is not being put into question, but we think that it is really important to make sure that this link between macroeconomic and financial stability is respected. And I think this graph shows quite interestingly, this is from a recent Kearney's speech, the relation between capital flows and the consequences in terms of disruption in the economy under certain circumstances. So that's fine. Then maybe just to point to some of the issues that I think one should keep in mind when thinking about how to address the potentially negative impacts of capital flows. One is to be clear about what do we mean by excessive volatility. So we are probably not going to come to a conclusion today on what is excessive volatility, but this notion of excessive volatility is a bit tricky to define because obviously it has to be defined against some sort of benchmark. That's one element that one needs to agree before coming to a view about whether there is a need to intervene or not, or to use capital flow management. The second one is the notion of persistent, to what extent the deviation is persistent or not. The third element that it's important to take into account is the link between, or the disconnection between exchange rate developments and capital flows. So we need to be clear about where is the source of the problem and what are we talking about. Are we talking about purely capital flow? Is that the trigger, or it is exchange rate, or how these two are interlinked? And the third one is the differentiation between levels and volatility. So when thinking about how to react or how to consider what could be a proper response in terms of capital flows management. In that respect, okay, we are not starting from zero. You all know the OECD code for capital flows liberalization. You all know the IMF institutional view on capital flows. There has been a lot of progress, I think we can say a lot of progress recently increasing consistency between these two. because in a way the OECD code comes more from a definitional legal point of view, while the IMF institutional view comes more from the empirical view. But at some point the two have to come together, because it's very difficult in the policy discussion to have kind of divergent conclusions of those two, even if the two would be well grounded in their respective approach. But it is important to have a consistent approach. It doesn't mean that the conclusion has to be the same, because one can well be in a situation where something is legally okay but not policy appropriate, or the other way around, and then it merits some clarification and some conclusion. The possible improvements here following the recommendations in the report, the way I see it, is one, I think there is a strong case that IMF could be given an explicit capital account remit, which at the moment doesn't have. One option could be to extend the mandate of the IMF to cover also financial accounts and enable to provide a global oversight of capital flows. Okay, here is the question whether there is, to do that one needs to modify the articles of agreement and so on, or whether one can do more by practice without entering into very complicated discussions to improve on that front. I think that probably the second one is at least the one to start first. And the second aspect, which we don't need to change any articles of agreement, is exactly what has already been mentioned, is this approach that the IMF seems to be developing now of this integrated policy framework, which basically means to have a more consistent analysis taking into account, in particular, the role of monetary policy, the exchange rate, and the macroprudential rules, and the capital flow management policies as sort of one integrated framework, and to see what is the best combination of those various elements in the policy response. So not only look at the capital flow management or macroprudential, but take into account these 5 types of policies that countries can put in place in an integrated way. So we think that this is a promising avenue for improving the reflection and the policy considerations in this front. And second, we think that the institutional view of the IMF could be, in a way, improved also as a result of this work. And I understand that there is an evaluation ongoing that can be instrumental in at least assessing whether this institutional view should be revised or not. And finally, as I already mentioned, this consistency between IMF and OECD, I think that at some points in the discussions in the past, sometimes there was a bit of a friction between the two, but I think this recent work on that should come to a better consistency between these two frameworks. Now, moving to the early warning risk assessment and relation with the policies, here one of the proposals, or in fact there are 2 proposals in the report. One is integrate the surveillance efforts of IMF, FSB, and BIS in a coherent global risk map, while preserving the independence of each of the 3 institutions. And the other one is make sure that this early warning exercise, in whatever form, is better connected with the policy follow-up. The experience is that indeed after the 2008 crisis, one of the initiatives that the G20 took at that moment was to reinforce the ability to spot risks and vulnerabilities that could lead to further systemic shocks, helping the policy discussion and helping to coordinate early policy responses. Well, why? Because everybody realized that more or less all the economists and institutions, we missed it. So that was the response of that failure. And the first dry run of this joint IMF-FSB early warning exercise took place in 2009. The report, the eminent person group report, says that maybe an improvement would be to include also the BIS and have a sort of coherent global risk map. I know that has triggered a bit of a negative reaction from IMF, from the others maybe as well, I'm not so sure. And in a way I understand, because it was a bit of a fear that if we embark in an exercise that we need to agree, on a common table, a common text, and we spend hours discussing, the exact drafting of the risk, that may not be very efficient. Also combined with the protection of the independence and the richness of having an independent assessment of each of the institutions, which I share somehow. I think it's good to have an independent assessment from IMF, from FSB, from BIS, because everyone takes a different perspective. So without necessarily going into having one single piece of paper for the exercise, I think that it would be good to strengthen the link between the assessment of the three institutions and have a sort of unified view about the risks, at least a unified discussion, and possibly, a sort of a basis for discussion that identifies one integrated list of risks to be looked at. So we see merits in going forward, trying to develop this proposal to come to some operational conclusions. And the second aspect is that, I think that would probably also help, or at least it would be worth to try to focus the exercise. I think the current early warning exercise, although, it's not widely known because it's conducted a bit on a closed doors way, but I think it has gone very wide, covering important risks, but maybe in a too wide sense, like cybersecurity, populism risk, and other issues that are very broad. And then it's very difficult to translate anything from this assessment into specific economic policy action. So that's the focusing of the exercise. I think that would be also something to be improved. And the third element is this link with the policy conclusions. So far, for several reasons, the conclusions of this risk or early warning exercise remained there. So there is no clear link between that and any of the exercises conducted by either IMF or G20 or other institutions in terms of policy recommendations. So we think that it would be merit to think about how to better link the conclusions of an early warning exercise looking at risks and the policy recommendations to address these risks, be country-specific or be coordinated action if needed at the global level. And in doing the early warning exercise, we also see that there would be merit to organize the exercise around three notions. One, the origin of the risks, whether it is external sector, fiscal developments, corporate, financial markets, contagion. That's one block. The other one, more about the magnitude of the risks, whether it requires domestic or international efforts. And the third block, based on the likelihood of the risks to materialize in short, medium, or long term. So these kind of categories would be a way to improve the exercise. And finally, moving to the third block of proposals around the global financial safety net. As I said, the composition of the global financial safety net has changed a lot. The components are diverse. So we have obviously the IMF, we have the regional financial arrangements, we have individual governments, we have central bank swaps, and other types of support that can be put in place on an ad hoc basis. And this is good to have. I think it's good that there have been developments, in particular in terms of regional financial arrangements, but that poses some challenges about how to manage all this. One reflection that I think it's relevant here is to say that we believe that the IMF has to remain at the center of this global financial safety net. At the same time, I think it's quite clear that if there would be a sort of systemic tail risk materializing, the IMF resources would not be sufficient. So clearly that points to the need to make those various elements of the system to work together. In particular, when we have in mind the current discussion about IMF resources, which is not going very easily, I would say, about keeping the current level or even increasing and ensuring that this will be the case. So this is still an open point to be maybe clarified at the autumn meetings, maybe not, we will see, depending whether the US are ready to take a clear view or not yet. I think that it's useful to look at one of the graphs in the report, just to have an idea of what I said here about the changes in the system, in the composition of the system. So there you see here clearly that the regional arrangements have taken a much greater role. And I think it's also important to have in mind that these regional arrangements are of a very, very different nature. So obviously I know better the European one or the European ones, but we have also done work with others, and some are really at the very beginning, some have not yet been tested at all. So it is another reason why a strong cooperation within those arrangements is, I think, particularly relevant and necessary. I think the differences are in terms of resources, in terms of governance, in terms of how much those regional financial arrangements have a surveillance function or not. All these are very important elements, and they are very, very different. And that's why, while saying that the IMF should be at the center, we also think that there is no one-size-fits-all in terms of relations between IMF and the regional arrangements, because those arrangements are so different. So it has to be a bit of on an ad hoc basis, taking into account the characteristics of each of the regional financial arrangements. But cooperation is very important for two reasons. One, to be quick and clear about the diagnostics. When identifying the risks, and be clear whether this will require those global financial safety nets to act or not. And two, to be as clear as possible ex ante about who is going to do what and how. We don't think that one should aim at very formalized ex ante arrangements, because I think it's probably not possible, and it will create lots of, I think, tensions and difficulties. But I think that some clarity in terms of having discussed the issues, how to go about it, between IMF, regional, then central banks, and also specific governments. I mean, I had discussions with countries like Australia and others about their experience in the Asian financial crisis, and they really would like to have some clarity about what may happen, because some of the countries do not belong to any regional financial arrangement, so they rely mainly on IMF, maybe swap agreements, but maybe not, because some have not really access to that. And then some countries are particularly exposed, and then they feel like they have to go bilaterally somehow, but without knowing what the others are going to do. So, for instance, in that particular case, Australia had to take decisions before knowing whether the IMF was going to go for that country or the other in the Asian financial crisis situation or not. So all this is probably not efficient. I think I can take out the probably. I think this is not efficient in terms of providing a response and using the resources in the best possible way. So that to say that we think improvement has to take place on that. And a promising element, I think, is that the regional financial arrangements have started to cope, at least to discuss together. So there is a regular meeting twice a year, and then there are some regular work together across the regional financial arrangements. I think it's a good step. It remains for the moment very informal, but I think that's a very interesting approach to be developed. And That has been triggered by the regional RFAs themselves, but the IMF also participates in this discussion. So I think this is a good step to be developed further, but it would be good to have the sort of the political impulse from the G20 also to go forward with this kind of activity, not only on the basis of self-consciousness, let's say. Last word from the EU level experience in terms of cooperation, and in particular cooperation with the IMF, that can be useful. I think that one element that it is very useful is to be clear about whether IMF has to be there together with the regional financial assessment by obligation, or it is a choice, or it is a presumption, or it is not at all a presumption. So I think clarity on that, and we have that in different degrees with our instruments. On macro-financial assistance, there is an obligation to go together with the IMF. This is for the non-EU member states. On the euro area ESM and balance of payments, there is to different degrees of presumption, but there is no obligation at all, and things may also evolve in the future. But that clarity on that is useful from our experience. And the second element from our experience, which is also very useful to be taken into account, is, as I said, to what extent the regional financial safety net has the economic surveillance function or not, and to what extent this can be fully left to the regional financial arrangement, and to what extent the IMF is needed for that. In our case, the EU has a very extended surveillance framework, so the role of the IMF on that particular aspect is not particularly necessary. The other question is about the amount of money available, whether the money or the resources available at the regional level are big enough, or whether the IMF is absolutely necessary because some have not so much resources. And then another aspect is about the potential role of technical support in order to get, in a way, the policy agreements in the programs implemented by the countries. And there again, I mean, we have, for instance, a structural reform support service. Other regional financial arrangements do not have it, so they will need more the IMF on that front, etc. So with that, I covered what I wanted to share with you as a reflection. Thank you.
Thank you very much, Elena. Maybe it's time now to turn to Mr. Al-Mutairi, who will introduce the G20's presidency's views. So you have the floor.
Thank you. I don't have any slides today. I will just state our views. These are in the planning phase. I think we still need to approach and consult with other colleagues in the G20 members, because, as you know, the G20 is a member-driven organization. Let me thank the Bank of Spain and the Reinventing Bretton Woods Committee for their kind invitation. We especially thank the Bank of Spain for the hospitality. It's an honor to participate today in this conference, which takes place 3/4 of a century after the original Bretton Woods meeting. Let me underline at the outset that we are supportive of maintaining a resilient and competitive world, which have helped to raise the living standards and lift large parts of the global population out of poverty. It is indeed striking how much the world has developed in the 75-year period since the Bretton Woods institutions were set up. In particular, I would say in the quarter century since the mid-90s. Of particular note, during this latter period has been an insertion of the emerging market and developing countries into the global trading and financial system. Some of them joining the Bretton Woods institution, others rejoining, and many of them also participating in the newly established international organizations. Along with this increased participation and inclusion of the emerging market and developing economies in the global financial system, the benefits of this multilateral economic and financial cooperation have been tremendous in terms of increasing life expectancy, better educational attainment, less poverty, and higher incomes. All this being said, we have to keep in mind the key findings made in the EPG report, that our central challenge is to create a cooperative international order for a world that is more multipolar in decision-making, yet more interconnected. Indeed, for a cooperative internationalism to thrive and sustain, individual countries have to conduct appropriate national policies with a view to achieving strong, sustainable, balanced, and inclusive growth in their respective domestic economies. Conversely, a well-functioning international monetary and financial system will allow for better economic outcomes at the national as well as at the global level. Also, to ensure the systematic resilience in the event of another global financial crisis, it is imperative that international monetary policymakers possess an effective toolkit and ultimately resources to respond to such episodes. The proposed reforms to the global financial resilience, if successfully enacted, could make a meaningful and beneficial differences to the functioning of the global economy. We have witnessed this in the past, just as we unfortunately have witnessed the opposite, namely the malfunctioning of the international monetary and financial system can exacerbate the problems in the global economy. We are examining in Saudi Arabia ways to take forward the relevant EPG proposals building on the progress made during the Japanese presidency. As a reminder, the Osaka G20 Leaders Summit in June concluded that, and I quote here from the communique, "We will continue our work on the EPG report proposals, recognizing their multi-year nature," end of quote. In this regard, the Saudi presidency would like to continue the work streams that the Japanese presidency has commenced and that still require some follow-up for their successful conclusion. Of course, not all of these work streams can be expected to conclude before we end the presidency in 2020. This confirms the message given by the Osaka summit on the multi-year nature of the work involved. But the work undertaken should make a positive contribution to enhancing the overall effectiveness of the global financial system. To further the work on EPG proposals in 2020, we would like to take note on the following. The EPG report identified some key focus areas, some of which the upcoming Saudi presidency will examine further in addition to other areas, in consultation with Troika and G20 members. The first area considers the benefits as well as the inherent volatility risks of international capital flows. Economic growth on a national and international scale depends significantly on the ability of the international monetary and financial system to facilitate investments, in other words, capital flows. Foreign direct investment, particularly for emerging and developing countries, can act as a backbone for development and the exchange of capital, broaden the scope for future economic growth. As such, the increasing integration of the global financial system has brought substantial benefits for domestic growth, but it has also heightened the risk of spillover effects during the times of stress. In particular, developing countries remain vulnerable to a sudden shift in the global risk sentiments and capital flows, largely because of the globalized nature of the current financial system. I think this message has been highlighted clearly in the discussion today. Encouraging as well as managing capital flows in a sustainable way is important to help develop deep, resilient, and inclusive domestic financial markets. Countries should be equipped with the right tools to observe international capital flows and thus managing volatility for a more sustainable development path. Supporting the development of domestic capital markets will aim to address the structural reformabilities given the current state of the equity and debt markets in developing countries. The G20 played a central role in the aftermath of the global financial crisis in 2008-2009 in mapping a collaborative path towards the restoration of stability, resilience, and economic growth. Since then, the global financial system has recovered significantly. However, the challenges haven't subsided. Indeed, the Saudi presidency is approaching at a time when the global macroeconomic outlook is at a crossroads, defined and driven by a unique set of challenges during a transition into a late phase of a business cycle at the back of trade disputes, broader geopolitical tensions, and growing debt vulnerabilities. Despite the persistence of risks to the global financial system, there is a parallel set of opportunities to strengthen the global financial system's resilience to future downturn and ultimately reinforce the path towards strong, sustainable, and inclusive growth. In 2020, efforts to strengthen the global financial system resilience to a downturn will follow a multi-pronged approach, as discussed earlier. Addressing structural vulnerabilities should be reinforced by efforts to support the development of deep, resilient, and inclusive domestic capital market that provide stable, sustainable financing. This can underpin the private sector and spur economic growth. As a final remark, we should indeed not lose sight of the fact that the global financial system needs to work for all, as the title of the EPG report reminds us. In guiding the follow-up work on the EPG proposals as upcoming G20 presidency, Saudi Arabia will be mindful and have an ear for the concerns of non-G20 members, just as it has always taken a keen interest in the economic challenges faced by emerging and developing market economies. Our numerous financial contribution to the multilateral, regional, and bilateral legs of the global financial safety net bear testimony to that. Thank you for your attention.
Thank you. Thank you, Mr. Al-Mutairi, for your intervention. Now, I would like to pass on the floor to Mr. Ottavio Damaso, who will focus his intervention on the emerging markets perspective. The floor is yours.
Thank you, Ms. Margarita. Allow me to begin my intervention by greeting my colleagues in this session and praising the Bank of Spain and the Reinventing Bretton Woods Committee for organizing this conference. Thank you for inviting me to be a panelist too. Attending the request done by the chair and in spirit of proposal brought by the EPG report, I will share some of my perspective about the current and future rules of international coordination for financial stability. I will focus on the challenging scenario for international financial architecture and briefly touch on the impacts of the innovation and emerging technologies in financial sector. International organizations are quite significant as standard-setting bodies, especially in considering the regulatory field. As you know, they contribute to dialogue and cooperation, provide comparability and harmonization of regulation, reinforce best practices, bring quality to international rulemaking, and more recently, improve their capacity to monitor and safeguard financial stability. One thing the global financial community has learned in these past 10 years is that we can accomplish more by working together. When the crisis struck, the international community came together to address in a coordinated fashion. the strengthening and enlarged the forum for international dialogue and coordination. The Basel Committee and the FSB gained renewed relevance. G20 was expanded with the inclusion of emerging markets. In this context, the Central Bank of Brazil has been part of the discussion about the international financial architecture since 2009, working actively on the economic and financial integration with other countries. Participating actively in this process has been important for my country, and I believe also for the other emerging economies. We have been given the opportunity to share our experience and challenges, contributing to building a strong and globally financial regulatory and supervisory frameworks. In this international forum, we set up an agenda to reform a fragile financial system. I find this a powerful piece of evidence that international cooperation can work. However, international cooperation is an ongoing endeavor. To ensure continued and consistent observance of standards by jurisdictions, we put monitoring mechanisms in place. Our jurisdictions are committed to undergo evaluation exercise. International bodies such as IMF and Basel Committee now publicly report the status of financial systems and regulations under its various surveillance vehicles. FSAPs and recaps became routine in our jurisdictions. We prepare for them, work hard to meet them, and learn lessons from them. Particularly concerning a more integrated system of risk surveillance, we support the idea that it should ideally combine this distinct lens of the IMF, FSB, and BIS, working together and along with regular inputs from regulators at a country level. Let me remind you that representatives from other international organizations, such as IMF, World Bank, BIS, IOSCO, are part of some of FSB groups and committees, especially those related to regulation and supervision, which shows a coordination effort among international organizations. In the case of FSB, the Standing Committee on Assessment of Vulnerability, SCAV, is the main structure aimed at identifying and evaluating financial system risks and vulnerabilities. SCAV is a committee that analyzes both the micro-financial vulnerabilities and risk derived from the system's structural weakness, reaching conclusions and analysis regarding the material of such risks. At the same time, Financial Stability Board's discussions are reflect both directly and indirectly in the work of other international organizations, such as the IMF, both early warning exercise and Global Financial Stability Report. I should also mention the effort through the FSB regional groups in disseminating those diagnoses and actions to jurisdictions that are not members of FSB. Such effort helps to spread the FSB work to more countries. Looking to the future, now and probably in the coming years, we intend to reinforce the monitoring of risk deriving from new technologies and financial innovations. Innovation pushes the boundaries of country regulation, challenges the international financial system architecture, and brings new and unknown possible risks to financial stability. On the one hand, we have new technologies, such as cloud services, artificial intelligence, Internet of Things, crypto assets, and quantum computing. On the other hand, we not only have the new kids on the block, such as payment institutions and fintech entities, but also the strong kids, such as the big techs, which are slowly approach the regulatory boundaries and, in some cases, are already within the regulatory perimeter. This is a call for deepening global coordination. International organizations are essential to incorporate the benefits of innovation in this new environment, while also facing the challenge to avoid that such innovation cause any kind of financial instability. In this regard, the FSB launched the Financial Innovation Network to monitor emerging emerging innovation, primarily from a financial stability perspective. The group has examined both technology-enabled financial innovation, fintechs, and non-fintech innovations. Their objective is to identify and better understand any innovation that may have global and material financial stability implications. This initiative has been bringing together other standard-setting bodies in order to avoid duplication or gaps. To conclude my initial remarks, I firmly believe that the efforts for a more intensive dialogue and cooperation in building a harmonized regulatory framework and an integrated surveillance effort have evolved significantly. However, there is always room for further improvements. Thank you.
Thank you very much. You will use it? Yeah.
No.
No? Ah, you won't.
Thank you. No, I
Thank you,
decided
Carlos.
for the sake of time to skip the slides and try to go straight to the message, particularly because most of the things I was planning to say have already been covered by my predecessors. So start with saying thanks to Banco de España and Margarita also for hosting this event and having invited the Treasury. And going straight to the point, from my side, the question that comes to our mind when considering this type of panels is whether we are well equipped or not for the next crisis. And of course, it's not a straightforward question to answer, but it's clear that in the G20 and FSB over the last few years, a lot has been done on the regulatory and on the supervision framework. A lot has been done, particularly on the front of banks, but also beyond that in terms of also financial market infrastructure and also in terms of client protection. But there are still some relevant holes where we have still a lot of work to do, for instance, in terms of shadow banking or non-banking financial intermediation, in terms of how to face financial innovation. And here we will be confronting also another round at the potential risk coming from the banking system under completely different parameters from the ones we've had in the past. So now banks have to reassess really the environment where they are doing business, not only because of new players like fintech, but also because in many countries because of this low for long rates environment. So the question is still open to debate. The Eminent Persons Group report goes in a broader direction, whether the whole system is really well equipped and how it can improve. To start with the notion, the idea that Elena mentioned also in the questions of a system. Well, clearly I would say that the world economy is a system, but it's also clear that it's not a well-organized system. We have countries, national economies that are increasingly interconnected. We have seen significant spillovers from what happens in one country to the rest. We saw that here in Europe during the crisis, where even what happened in a very small European economy like Cyprus could have an impact in the whole Eurozone. We've seen it more recently in emerging markets, where the situation in two specific cases like Turkey and Argentina had a contagion over emerging markets and capital flows to all emerging markets. So clearly there's a connection, and this has not diminished. If anything, it has increased. Also, technology has had an impact here, making economies and institutions and agents closer every day. But one of the reasons why also I said that it's not a well-organized system is not only because of its institutional framework, where the report already gives good indications on how to improve that. It's also, if you look at the international monetary system, although you have here a paradox, you have a multi-tier system where there are a lot of big players, there are a lot of medium-sized players, there are several super big players. It's not only US, you have China, you have Japan, you have the European Union, you have Brazil, India, you have Russia. Then you have many other medium and smaller size players. But if you look at the monetary system, it's clearly a dollar-centered system. And here there's a bias here. When I was talking about contagion effects or spillover effects, the role that the dollar plays in the monetary system also assigns to the US economy particularly relevant role when affecting or having a strong influence in the rest of the world. So countries will be, national economies will be influenced not by what they're doing, not by their own economic fundamentals, but because of what's going on in other economies. And these are some of the issues that have to be addressed by reviewing the institutional framework behind the world economy system, and in the direction of which some of the recommendations from the report go. I will not go into all these recommendations. Elena already did it, and have been also covered by my two predecessors. I'll just highlight, in my opinion, also sitting in these G20 FSB meetings, where I see that some of the actions have to be taken in the short term and medium term, and looking more broadly, not about non-banking or about financial innovation, but more broadly about the whole world economic system. Here, the first thing, and it's very urgent, is that we close the 15th quarter review of the IMF. Before summer, it looked like we were pretty close to an agreement to preserve the level of resources of the IMF, at least. Now it's not done yet. We're approaching the next annual meetings in October, and ideally we should have a clear view there of how the resources are going to be maintained. If it's not through a quota increase, then are the multilateral lending, the multilateral loans, the NAP, are going to be increased to preserve the level of resources and stop relying as much as they currently do on bilateral loans, which is not really ideal from a multilateral point of view. So this is first, finalize the 15th quarter review before we start with the 16th quarter review, which is, the process is going to open pretty soon. Second, is not only a matter of resources, it's also a matter of tools. What tools the IMF and the regional systems can do. First, they have to coordinate, as has been highlighted in the report. But second, we also think they have to innovate. So it's good that we look at different alternatives in the toolbox beyond the traditional programs. And here the role of precautionary instruments can be important, just to try to address the crisis situation before they have become really unstoppable. This has been in place for some time in the pipeline of the toolbox. Have never been these type of instruments, precautionary instruments, be widely used and really effective. So we have to work a little bit harder on the design of these precautionary instruments so they are really effective and can protect the so-called innocent bystanders, which are economies that has a very solid fundamentals, but are suddenly affected by what's going on in a neighborhood country, in a neighborhood economy, and that don't really need a program with conditionality, but need some support to regain access to the markets. So it's the 15th review is the toolbox with a bigger role for precautionary instruments, and more looking at the medium term, which is also how we should look at it, how to deal with this paradox of a dollar-centered monetary system. And here, I think central banks have a lot to say, and also with the capacities that the possibilities that the new technology bring to all of us, it will be good that it's and more probably sustainable and reliable if it's central banks who use this technology to create the right currencies for dealing with this multi-tier system than if it comes from the private. So I think here also there's a lot of work to do at the national and international level. Let me just finalize with a few words on the situation here in Europe. If we go from the world system to the European economic system, and here we have gone through a very similar analysis. And we are currently in the process of improving our own tools for a better functioning European economic system. I would like to highlight four issues here. One is that we are working hard for the real completion of an integrated financial market in Europe, not just the banking union, also capital markets union. There are a lot of things to do. Banking union achieved very significant results in the early years after the crisis with the single supervision, single resolution. But there are many other things to do. Not only single deposit insurance, the EDIS, it goes much beyond EDIS. It goes into a situation where the banks, the participants, the clients, the customers can consider at least the European Monetary Union as their one single market that will generate additional opportunities for all of them, for investors, for the banks, for the financial system as a whole, and for savers and for clients as well. So this is one issue where we've been working very hard, and where there will be more work to be done in the coming years. Second is the reform of the European Stability Mechanism, the ESM. And here we're moving in a direction to make the ESM better suited for handling future crises, so strengthening its capacities to really work in conjunction with the Commission to be ready in case there are some economies going into trouble, but also developing some sort of these precautionary instruments that can help countries before they are really in a situation where the only option is to go for a program. You know how difficult it is for a national government to file for a program, be it ASM or be it IMF. It carries a stigma, a political stigma, but also economic stigma. So precautionary instruments can help countries address their difficulties in the early years before it's too late. So we'll see if the amendments to the regulation of the ESM in this direction are effective to help us cope with crises in the future. I said there are four issues I wanted to deal with. One is banking union, capital markets union. Another is the ESM. The third one would be the stabilization function. We really think that here in Europe, particularly in the European Monetary Union, well, the academic arguments are clear there. So there's a clear need for a stabilization function, given that we have one single monetary policy, we have just one single currency, exchange rate. So national fiscal policies have a big role to play. They are the first line of defense, but some sort of stabilization among countries can help, because there is a clear case of contagion here in one single currency area, as is our case. And if you leave all the burden of adjustment in the national policy, sometimes it can be a little bit too extreme. It can lead to overshooting. And in some cases, for instance, we saw that in Spain, but in also some other countries in Europe, the fiscal adjustment had to be so intense that the reduction on public investment is huge, the impact on employment is huge, and the recovery is much more difficult. So if you have in a situation where some other economies in the single currency have more of a less stringent situation, can provide some additional funds through the economy or through a specific fund well established, you can smooth a little bit the transition of these countries throughout the crisis, minimizing the impact, or at least reducing the impact of the crisis for the country and for the system as a whole. And last, on these euro issues, I want us to highlight the importance that we think could have having a safe asset in the European Monetary Union. It's a debate that has been going on for several years. There will be more to come. It has some political implications, but economically, and financially, you can really see that there's a clear scarcity of risk-free assets in Europe, if you consider as such the bond, the German debt, and with some level of some other issues like the Dutch in this environment where we see less and less of these safe assets, clearly trigger some imbalances between sovereign debts across the economies, and some scarcity also for the participants to have a safe asset big enough for them to carry out their investment policy. So, as you see, a lot of work to be done here domestically at home. Also, a lot to be done at the world economy level. Going back to the question in the beginning, are we well equipped? Well, it's hard to say yes or no. The answer probably is we are better equipped than we were 10 years ago, but there's more to do, and the recommendations on the EPG report will help us probably get a little bit closer. Thank you very much.
Thank you. Thank you, Carlos. Thank you, Carlos, for your intervention. So now, maybe Mr. Frankel, could you say a few words, or would you like to say a few words on the report to add something to what has been said? Okay. Okay, thank you. So now, if time allows me, I would like to raise maybe some follow-up questions very quickly to each of you, maybe by starting with Elena. I'm picking up one of the last topics that Carlos just mentioned. So what about the Capital Market Union? So the report recommends deepening domestic financial markets, of course, including the development of sound capital markets. And now in Europe, so related to this, what's your opinion on the steps already taken in the EU towards this goal?
Yes, indeed. I mean, as Carlos said, that's one of the elements that I think we don't need to explain why. I think it's pretty clear that this has to be developed in order to really allow the European Union or the euro area to have a truly single financial market and to reap the benefits from that. And it is also one of the elements that I think are relevant when one thinks about the multipolar currency world. I mean, if the euro has to become a globally used currency more than what it is today, it has to be attractive. And to be attractive, capital markets union and a single financial market is a very key aspect of it. So for those two reasons, I think for both domestic mobilization of resources, but and appropriate efficient allocation, but also for international role of the euro, it's a very pertinent element. So there has been a lot of work done, as Carlos said, and proposals made on the table. Some have progressed more and others less. I think if I have to name some of the structural issues that need to make more progress, I think I would point to one, the insolvency law area, where still we have divergent national laws that it has an impact on investors' confidence when it comes to cross-border investment. So that's one element where we for sure need to make progress. It's not easy because it goes into domestic civil law and other kind of things that are not necessarily at the EU level management or domain of responsibility, but it has to be much more consistent and see whether we need common elements on that. The second area, I would say, the securities law. For instance, securities ownership rights, which national laws apply in a cross-border transfer of a collateral, etc. So clarity on that and has to be much more developed. The third area, obviously, is taxation. I mean, again, another area where there is no community competence as such at the EU level, but clearly this is a barrier in a number of respects. Just to mention one, issues with lengthy and burdensome recovery of withheld tax and other kind of things. So even not going for a sort of a single taxation decision, but at least to remove a lot of this complexity and uncertainties that we still have. And fourth, the supervision, clearly the lack of clarity when it comes to supervisory outcome. So those are areas where I think we need to make quick progress. All that is covered in the action plan and so on, but from action plan to action and decision, we are not yet there.
Okay, let's hope that the new Commission will take the right steps into the right direction. Thank you, Elena. So maybe following up on your remarks, Mr. Al-Mutairi, my question would be around policy coordination. The report makes it clear-cut that more international coordination should be encouraged to address global risks, such as increasing volatility in capital flows and negative spillovers. So I would be interested in your views and the views of potentially of the G20 presidency to continue strengthening coordination and communication among all the national authorities. What are your views on this topic?
Thank you so much for the question. I benefited from today's discussion. They have highlighted a lot of risks. Capital flow is only one of them. They have highlighted the slowdown in economic growth, the low inflation rates, the low interest rates. They have talked about the integration of the emerging markets into the global financial markets. They highlighted the significant risks currently under the radar. So all of these tells you how important is that we need to be coordinating closely and heavily. It's not a normal time. The G20 has been effective, and they continue to be critical forum for discussion and elaboration in these issues, taking collective actions, having a global issues on the table with due consideration to country-specific circumstances. So the presidency always put the coordination and communication an element of success. So what we are planning, as has been done always, is to enforce the coordination, present the timely issues, and also with a strategic view and a medium and long-term view of the global challenges that are facing the global economy. So it's a mix of urgent, medium, and long-term view of all these challenges. And this maybe doesn't limit ourselves to the finance track issues. We are discussing some of them, but also in the Sherpa track, there are different issues that will be have been already under discussion, and they will continue to be under discussion. So, of course, I would like to highlight the role also of the international organization in providing the technical advice and doing a lot of technical work. So they enhance the richness of the discussion within the G20 member. The G20 doesn't constrain itself to its members. It has outreach to non-G20 members. I highlighted this in my speech. So there are invited countries, but also in the outreach we do consider their challenges and have them addressed and discussed. It doesn't also, the G20 doesn't only look at the countries and the policies, etc., but also they look at the private sector issues. We were talking today about some of the vulnerabilities, is the increase in the non-bank financial intermediaries risk, etc. So I think the G20 has a role in the engagement group. We have the B20, Labor 20. All these will provide a useful input to the discussion within the G20. So it's a very comprehensive way to look at all the issues, including all the stakeholders who have interest, and they will be heard and approached. I wouldn't take a long time, but I think this is summarize the whole. At the end, the G20 is a consensus-based forum, and the presidency will navigate through these agenda items to make a successful outcome.
Thank you. And now my question, of course, goes to Ottavio. This is linked to the new technologies and innovation. The report argues that the new technologies, among other factors, of course, are contributing to the continuous evolution of the complexity, both complexity and interconnectivity of the system. So, what, in your opinion, are the challenges that are brought by the new technologies and innovation, and the risks derived from them? And also, maybe you could give us your ideas and opinion about the situation in Brazil and maybe other emerging countries.
Okay, thank you. Thank you for your question. It is a good question. To understand the challenge and the risk derived from the innovation and new technology in the financial sector, I suggest to divide in three parts regarding specifically from the risk. First is the new players and the new business model. The second is new technologies themselves. And the third part is regarding cybercrime. So returning to the first one, new players and the new business model, we have two kinds of new players. One is the fintechs. They are small companies, they are small entities. Some fintechs are growing and bother the traditional institutions, but if we put all together, they don't face, I cannot see any major risk for financial stability from the fintech areas. When you go to the big techs, it is different. First, the big techs are third-part providers for financial sectors. So even out of the financial perimeter, they are systemically important for financial institutions. But the another way is they are coming to the financial sector, and they have a deeper pocket, and they have the possibility to scalability very quickly. So when they enter in the financial sector, we need to monitor carefully this movement to not impose any kind of financial risk to financial system. So it is the first point. The second point is regarding the new technology themselves. You take the experience of artificial intelligence. Everybody knows the benefits that artificial intelligence can bring to financial system. I will not talk about this here, but there are some concerns, there are some doubts about artificial intelligence. Example about the models, the algorithms, and the unintended consequence that they occur to the financial system is one question. The other question is related to the data privacy legislation. Everybody knows that the artificial intelligence must use a lot of data from customers and the market to be useful. So there are many questions regarding artificial intelligence, and there are many questions regarding another technologies like blockchain, like machine learning, cryptocurrencies, and other things. So the new technologies themselves, there are challenges and risks to be known and to be mitigated too. And the third one is the cybercrime. The cybercrime, I think, is the major challenge that we have. It is already in place. It is commonly cross-jurisdiction crime, so it is too difficult to control. And in the case of cybercrime, probably require more cooperation among countries involving international organizations to face with it. So I think, of course, when we are looking to those, to this map, there is many benefits, but there are many challenges and risks to be understanding and to be mitigating.
Thank you. Very clear. So maybe my last question before opening the floor for additional questions is linked to macroprudential policy, and this goes to Carlos. So the report points out that the comprehensive understanding of the drivers of the capital flows and their interaction with monetary, exchange rate, and macroprudential policies is necessary. So what are your views and your opinions on the reforms to the international regulatory frameworks, in particular regarding macroprudential policy? How can this help to prevent or mitigate some of the risks identified in the report?
Yeah, thank you. That's an excellent question, also because we both sit in the Spanish macroprudential authority, so you know what we're talking about. And when I was saying before that there's a question as to how well equipped we are for the coming crisis, probably the macroprudential instruments and the macroprudential authorities are one of the more significant improvements we have experienced in recent years. And they go hand in hand, so it's not enough to have a macroprudential authority to overlook the situation in the economy and identify potential risk. It's also very important that the market supervisors have in their toolbox the proper instruments. And as a result of all the discussions going on in the different framework internationally, most of national supervisors have increased their capacity to act in the economy in anticipation. Here in Spain, as recently as last year, the toolbox of the supervisors, Banco de España, but also CNMV for the securities markets, and the insurance general directorate for the insurance company have improved. And I really think that if we look at how the crisis unfolded in Spain some 10, 12 years ago, had we had a macroprudential authority at that time and had the supervisors already had in place the right tools that they currently have, I believe that looking only at our own case, domestic case, the measures could have been taken, maybe not to completely avoid the crisis, because the crisis didn't only have root in the situation in Spain, it was an international crisis, but definitely how deeply it hit us, because we had accumulated some imbalances for several years that in the presence of a macroprudential authority, I think would have been evident that there was need for some action, and I guess some action would have been adopted. And I believe that this happens across Europe and in many other countries that have adopted macroprudential institutions and tools. In Europe, we have only seen that in some countries macroprudential tools have already been implemented in terms of limited, capital buffers or so on. So I really think that this is one of the areas where significant improvement has been taken, that should put us in a better condition for facing the coming crisis.
Okay, thank you. So now I will be delighted if someone from the floor would like to raise one or two questions.
Margarita.
Here.
Thank you. I must say that as a member of the EPG, it is one of the most flattering experiences to have a panel like this discuss the report. But I would like to share with you some both concerns and thoughts. When the EPG was formed, by the way, the name EPG, very pretentious name, Eminent Persons Group, was not given by members of the EPG. The group was led by a very skillful navigator, Deputy Prime Minister at the time, Tharman Shanmugaratnam from Singapore. And the main point was, first of all, it's a report while commissioned by the G20, but it is supposed to address completely symmetrically both developed and emerging countries. So it's really a system report. When we joined the report, the profile of members of the EPG was very similar. People who have had experience in the public sector, whether they are still in it or not, but have some perspective in one way or another. The main concern we had was that here there will be another report that will join all the previous reports on the shelf, etc. And we spent a lot of time asking the question, how do we ensure that it will not end up in the graveyard of previous reports? There are some structural issues that are obstacles. It was initiated during the German presidency. It was moving on through the Argentinian presidency and navigated further by the Saudi Arabia presidency. The problem is these presidencies are a one-year rotation, and there is a built-in challenge how to ensure continuity when there is no formal secretariat, even though there are informal ways to go about it. Like all reports, and this one in particular, it requires a champion. Somebody must own it. Formally speaking, the EPG group has dismantled itself the day the report was submitted. But many people, including Elena this afternoon, and others said, well, this is supposed to be a living organ that moves on across presidencies. It's a work program in progress. Nobody expects things to be from one day to the other. But we are left to informal gatherings like those. And those of us who are experienced know that in the official sector, unless there is an official champion, it will become an interesting footnote in history. So I really believe very strongly that if you want to adopt it, and this time is in the hands of the Saudis or whatever, it needs to have an endorsement in one way or another, not of the results, because the conclusions may be controversial, but of the process that we need to have this machinery. We can start something new altogether, which is perfectly fine. I think it will be a waste. But something of this type probably needs to be there. No single organization will generate it, because the whole idea is the intersection across organizations. And so the thought of, at that time, Minister Schauble from Germany was that this would be one way to go about it. If it is, we should water the flower, otherwise it will go away. Thank you.
Thank you. We really take note of your suggestions. Thank you. Any reaction to this comment or?
Well, maybe I would like to say that for sure it will not be enough that the EU takes that role. I think we need some other members also of the G20 to take this owning the report, but I think there are some others. The question is that I would like to stress, what you said. I think that the global environment has changed in a way that makes it even more relevant. And with the slowdown as we see it, partly cyclical, partly structural, so we need to make sure that the key elements of the report make progress to be in a better position to avoid, to the extent possible, crises and to face them. And I think that I would recommend to the presidencies that making the case for the relevance of a number of the proposals in the report should be put on the table when we discuss macroeconomic policy issues and macroeconomic policy risks, and to link the discussion of risks and responses with the proposals of the report, and not take the report as something else to be put on the agenda, but link to the core of the G20, which is macroeconomic policy coordination.
Okay.
Thank you very much. I would like to go back to Mrs. Flores' comments, and I have to say there can be a very different reading as how you put it as to the position of the EU regarding the IMF. And I have to say I find your comment that the EU would like to preserve the IMF at the center of the multilateral system as quite disingenuous. I think the EU has done a lot to undermine the IMF. That is true with regard to the Troika, that has effectively made decision on the EU adjustment be taken in Brussels and in Berlin. That is certainly true with regard to the ESM as well, which is meaning a greater fragmentation of the global financial safety net. And I think it's also true regarding its insistence on maintaining the position of the MD for Europeans. So I think the EU is a threat to the multilateral system. And if you'd like to ask me, what is it that the EU could do to strengthen the multilateral system, well, then it is to tone down its role and in fact push for the 15th review to be concluded on the quota and make sure that the IMF as a multilateral institution can actually survive.
Should I take that one? It was a comment or a question, I don't know, but I think that...
I would be most interested in your comment, yes.
No. Again, I stress that I'm really expressing myself from my experience, so don't take it as a fully formal position, but I think that you should be careful about making the difference between EU positions and some important EU member states' views about things, etc. But if I take the EU position regarding the conclusion of the 15th quota review, I think that what you said is wrong, because the EU has been pushing for this like hell. We have had a coordination position with EU member states, and we always said that the IMF should remain a quota-based institution. And I should remind that both in the NAP and on the bilateral borrowing arrangements, I think that the EU took really the big part of it. So in terms of ensuring the adequacy of IMF resources to be active wherever in the world, I think that the EU has provided its share more than what it should. And we are also consistently defending the reallocation of governance rights according to the emergence of different weights across, advanced and emerging economies. And we know that this, in the medium-long term, will imply a loss for the EU, because if you just look at the numbers, GDP project that in whatever way in the medium term, it's clear. And yes, some members of the EU, eminent members, don't like to see that, but this is what it is. So we have to, but on the 15th quota, that's clear. On the role of the IMF at the center of the global financial safety net. Yes, I mean, I didn't register, but I can recall a lot of recent discussions about this, where some of the big G20 members wanted to really remove that from the table because they consider that given that we have all these regional financial arrangements, swaps, and etc., we don't need the IMF at the center, and therefore we don't need the IMF to keep the current level of resources. So that's clearly the US position, to name it. So I think that both the EU and the EU members of the G20, they have really fought against this view. Now, coming to your critical point, which is divergences between IMF and EU or European Commission within the Troika in specific program cases, yes, it's true. There have been divergences, there have been even disputes, I would say. I was myself in charge of the Latvia program, that's very long ago, where we had a big fight with the IMF about whether Latvia should keep the exchange rate fixed or they should let it go. Okay, time, I think, proved that the EU had probably the correct view. But never mind, yes, there are moments where there are different views, and in those moments, some countries claim that we don't need the IMF, we don't want the IMF is kind of bothering us in this particular discussion, but I don't think that this has really had any bearing on EU position regarding the IMF at the center of the system. I'm not going to comment about keeping the European label on the IMD because I think this is part of the overall political balances that I'm not sure that I master fully.
Okay, maybe one last question here.
Yeah, a very quick question maybe for Saudi Arabia, but for any member of the panel. But don't feel that you are going to talk or to represent your forthcoming G20 presidency, but maybe more in your personal capacity. There was a G7 meeting a month ago in France, and there was, for the first time for many years, no communique. You know, there was clearly a way to say, well, we don't need to have a communique, people don't pay attention to communique. We talked today a lot about crisis in multilateralism, spillovers, and so on. So as the next chair of G20, maybe you can argue, you can think about not to come up with any type of G20 communique. That maybe will help reaching a more consensus among the members without, you know, being in the pressure to come up with a G20 communique. And the other issue that I wanted to mention, and the Deputy Governor of Brazil mentioned a lot about cyber crime, cyber security. Another innovation, you know, the Financial Stability Board and the Financial Stability Forum were created 20 years ago. And it was clearly looking at prevention of financial crises and looking at vulnerabilities in the international financial system, bringing together regulators and central bank. And that was the Einstein-Meyer view that at that time, you know, we didn't have a real forum to bring these two stakeholders together. Now, the type of risk we have in the system are more dealing with cyber risk, big data, and so on. Maybe Saudi Arabia can suggest that Financial Stability Forum or the Financial Stability Board can be enlarged to bring together maybe other stakeholders like competition authorities, data, and so on. So this is maybe something that you can think in your forthcoming presidency. Thank you.
Any reaction to that?
Yeah, no, thank you, Marco, for your questions. First one on the communiques. I think it's premature to conclude that there will not be a communique. The G20 has been through several rounds of issuing these communiques, even in more difficult times. The presidency has to make all its efforts to reach consensus among all G20 members. I think there must be a middle ground and area of comfort where all G20 countries can come together, especially in this time. It's a very challenging period. I think whatever comes from the G20 will be helpful for the global economy to comfort the markets. So we keep on making sure that we discuss thoroughly all the risks and the challenges, but at the same time be prepared on how to deal with them. It's been the tradition of the G20 to issue communiques and we will continue as a presidency to continue these efforts. The communiques, you have the original communique, but at the same time, you have other statements which are attached usually on the communique, addressing certain issues of particular interest at that specific period of time. And the G20 always come together. It's the important forum. It's the forum for global cooperation and whatever challenges the global economy are facing, it will continue to be an important forum for dialogue and proceeding and overcoming, addressing all the challenges facing the global economy. We have to focus on the broader picture and the objective of the G20. It's about growth, how to maintain strong, sustainable, and balanced growth. And that's the ultimate objective, that whatever discussion or complications in the process, we have to be cognizant of what we want to achieve at the end. So this is need to keep in mind. Other question, I think it belongs to institutional arrangement. You mentioned FSB. I think this is need to be a collective thought by the membership of the institution. But again, it will be based on thoughts of the member of that institution, and it has to be something that is underpinned by evidence, whether we need to move ahead with certain proposals of that sort. But it's something that I will leave for the respective member of the institution.
Any reaction on financial innovation? Okay, so I think we had excellent presentations today, and thank you very much again to all the speakers for your kind participation. Maybe just a few words as closing remarks. As Governor Hernández de Cos mentioned in his opening remarks this morning, the world is changing, and multilateralism is being challenged by multiple and globally interconnected forces. So the response to these challenges requires a rethinking of the global governance to adapt to the new realities, but also the need to preserve the basic principle of promoting mutual understanding and broad coordinated policy efforts. Complementarity between sound domestic policies, international cooperation and robust global financial safety nets that accommodates both regional and multilateral actors should be core elements of the global financial system. So I hope that these reflections and discussions we had during this session contributed to give a step further in our understanding of the issues at stake. So thank you very much again. Thank you.